Got a couple of questions in the chat for you. This is the first one up.
From RC. Thank you, RC. Would deposit insurance policies for depositors with amounts in excess of the FDIC $250,000 permanently solve the bank run dilemma? No, I don't think so, and here's why. The issues I think you're going to find is, are they running a good bank or not? Are they balanced in their approach to risk or not? And we can see Silicon Valley Bank having depositors insured all the way up maybe would have made Silicon Valley Bank even more risky. Because remember, they took risks buying bonds, and then the market interest rates changed and those bonds were underwater. That has nothing to do with the insurance that the federal government gives to depositors. If the federal government was to say infinite insurance for depositors, part of what could happen there is that the banks could be more irresponsible. Hey, screw it. You know, we may get sued by investors, but we're not going to get sued by the depositors because the federal government is going to protect all their money. That's actually a way to have a moral hazard and an unintended consequence. So I don't think the answer is that. I think the answer is maybe closer examination of the ratio analysis that they put on banks to determine their creditworthiness and health. And there's a lot of ways you can do that without choking the banks. There have been regulations that were out there that were actually worked well for big banks, but actually would choke little banks and were unnecessary when you step back and look at the little bank and look at what their risk profile was. So I don't think the raising FDIC would help. It might help you and me feel good, but it also may have the unintended consequences of banks are just more fearless about behaving badly. And that's not one that I think I want to incentivize.